Hi there, I'm Jeff Montgomery and welcome back to our channel. If you started thinking about creating income for retirement, chances are that you have heard about annuities. Annuities are designed to help you maintain your lifestyle after those regular paychecks stop. But are they right for you? There are a variety of annuities out there that are available for you to purchase, but not all are created equal. In today's session, we're going to explore the ABCs of protected retirement income and help you determine if an annuity might be right as part of your financial strategy. Specifically, we're going to do a deep dive into fixed index annuities. So let's go ahead and get started. Well, let's start with the basics. There are two main categories of annuities. There are immediate annuities where you start receiving guaranteed income payments right away. There are also deferred annuities which allow your money to grow over time, generating income, additional income, and they'll come in a few different types. We have fixed index annuities, which we're going to talk about today. We have fixed annuities that provide a guaranteed rate of return. And we have variable annuities that come with greater risk because they are variable. So let's specifically today, on today's episode, let's just talk about how fixed annuities work in general, and I think you might find them interesting. Your annuity earns interest based on an external market index. The most popular one out there that you'll see in a variety of publications is the S&P 500. But unlike investing in the stock market directly, your principal is shielded from any market downturns. I think the best way to explain this is maybe look at a hypothetical example. For example, if the market indicated by the S&P 500 grows by 10%, and let's say the index, the FIA, fixed index annuity, has a 60% participation rate, your interest or your earnings that year would be 6%. Now that's interesting. You don't get the full 10% if the index did go up 10% because you're also not taking any risk in that situation. So here's how fixed index annuities can really help. For example, the 2008 financial crisis, you could also look at 2022 where markets dropped pretty significantly that year. The S&P occasionally can drop and can drop pretty dramatically. The FIA remains steady. There are no losses in your account or your principal or previous earned interest in that example when the market drops. However, before purchasing an FIA, it's essential to ask yourself a few key questions. Number one, what is your primary goal? Is it protection? Is it growth? Maybe it's both. How much risk are you comfortable with as part of your overall investment plan, adding a fixed index annuity to that investment plan? There's no one size fits all, so that's an important question to see how does that fit in. Also, fixed index annuities come with some costs and some limitations, so let's break those down a little bit. Number one is surrender charges. You need to understand that early withdrawals out of a fixed index annuity or deferred annuity may incur some penalties that they call surrender charges. There are also limits to liquidity in these products, again, because most of those are designed for protection and income in the future, but liquidity considerations should be examined because you don't want to put all your eggs in one basket in case you need that money and you want to avoid surrender charges. Another one is commissions. These are paid by the insurance company to the financial professional that sets this up for you, not directly out of your own pocket. However, you need to explore and understand, is there any conflict of interest in this arrangement for the recommendation of that inside your existing plan? There could be rider fees. These are optional features that enhance income, maybe enhance death benefit, maybe have some long-term care protections, but those typically come at an additional cost. Caps. These are limits on how much interest your annuity can actually earn. We talked about participation rate earlier, but there's also a cap rate, for example, as an alternative index election or in conjunction with other types of index elections. But let's just say the S&P 500 in this example increases 10% and your annuity had a 3% cap. Your interest credited that year would be 3%. Making your money last in retirement isn't always straightforward. So we always recommend consult a financial professional for guidance in this area and see if this fits in your plan. So whether it's understanding the fine print or evaluating how FIAs could fit inside your plan, we are here to help. So I want to thank you for watching. If you found this video helpful, please give it a thumbs up and subscribe for more insights into financial planning and retirement strategies. And remember, your retirement dreams are achievable with the right plan. Reach out to us to learn more how we can help in this next chapter in your life. Until next time, I'm Jeff Montgomery.